Welcome. Hello, TV listeners. You're listening to Topline, the podcast brought to you by Asid Zaman, CEO of Sales Talent Agency, AJ Bruno, CEO of Budapest, Sam Jacobs, CEO of Pavilion. AJ and I are live in Boston. Asid is live in Toronto. We're all humans on planet Earth, part of the same quantum field.
If you're wondering, if you're watching the YouTube and you're looking and you're like, AJ, where are you compared to where is Sam? Sam has the corner office right now. I have the janitor's closet. It's great.
It's literally like a booth.
we are at the Pavilion co-working day, the day before the CRO Summit. We're going to start doing these. This is sponsored by WeWork, so thank you, WeWork. They are providing us an entire floor. They provided us snacks and food, and all for Pavilion members that are either Boston Pavilion members or attending the CRO Summit tomorrow. We're going to do one in London for the EMEA Summit. We'll do one in Austin for GTM, and I think we're going to do one every time we do a summit, so it's going to be great.
I really like this because I hate working in a hotel room.
Yeah, and this way we can all be together and have random meetups and bump-ins.
The funny thing is, like many years ago, Sam used to talk about opening clubhouses so that you go to a city and there's a clubhouse and everybody can go there and hang out. Kind of like a Soho house, but for work. Yeah. And I loved that idea. This gives you a version of that.
I thought you were going to say Sam started Clubhouse. Remember the app that everyone was in during COVID?
It was worth $1 billion so very, very briefly. And the main topic of conversation on Clubhouse was like how to be on Clubhouse. It was the most meta place. It was like, oh, there's all these new people here from Twitter, but this is what's interesting about Clubhouse is like that's all of the themes were like what anyway.
Were you presenting on Clubhouse, Sam?
No, I was on it once or twice, and then I stopped and never came back, and then Twitter created Spaces, and now Clubhouse is over. But they had so much growth, and they would have these town hall meetings, and it was all so self-referential. You know, it was like, anyway, I found it interesting. It was very meta.
There were two from that period, Cameo and Clubhouse, both with C names, and both are done now. It's really interesting that in these certain moments, what takes off like wildfire, where it lands up in the future.
Yes, and the last thing I was going to say about that comment, Asid, is that every time I brought up the concept of a Clubhouse to my board, they like, do not bring that in here. We're not getting it. Your business is complicated enough without getting into the real estate business.
It's so funny that Sam said I pitched to our early stage investors something called QP Collective. Cole, my co-founder, and I were like, what if we had a WeWork type space for salespeople where you had phones and you had Red Bull and you had quota boards and you had gongs and bells? And they hated it. They said that doesn't sound like a business I want to invest in, AJ.
Welcome to Topline, the podcast for the best founders, operators, and investors in B2B tech. Every week, AJ Bruno, Asid Zaman, and me, Sam Jacobs, will break down what's important for you to know to be the most well-informed professionals in the market.
This episode of the Pavilion Podcast is brought to you by AirCall, the business communications intelligence platform. With AirCall, you can bring your CRM and help desk together with your phone, chat, and messaging system to save time and resource on customer communications, admin, and reporting. To deliver an even better customer service, visit AirCall. That's AIRCALL.io.
Vince Beese, or BC, who is the chapter head for Raleigh-Durham from Pavilion, is doing exactly that, AJ. He's got a sales co-working space in Raleigh-Durham so that all the salespeople that can't get into the office can be in one office together so they can collaborate. Pretty cool idea.
I love
Especially for early stage, right? Like if you're I always think about my first 100 cold calls. They were so bad. And imagine if Sherry, my partner, was listening to me just getting killed on these cold calls. It would be so hard. Or like my roommate, who's a financial analyst sitting on Excel, just hearing me struggle. There was something to say about learning by osmosis and then just being around people that are going through the exact same journey early on in your career. I think that's so important. So it's a really good idea.
Yeah. Well, JR is listening to this right now, and he was the one that was like, nope, you're not. To JR's credit, he actually had a co-working space in Houston that he was the CEO of. In Houston. So
and every day he wakes up, he's so happy to not be in that business anymore.
Agree.
All right. Go ahead, Austin.
Okay. So we have to talk about what happened in the public markets last week and generally macro. So last week, Salesforce announced its first revenue miss since 2006, and it was a very marginal miss. But the bigger thing was that it reduced its guidance for the coming quarter. And they're now growing less than 10%, which is not supposed to be possible for enterprise leaders like Salesforce. They're supposed to be able to maintain 115% NRR or more. There's a playbook for that. It's not working right now, and that's causing a lot of anxiety and questions in the ecosystem. The result of this was that Wall Street wiped off 50 billion from their market cap, which is the equivalent of Databricks. And Stripe was valued at that, I think, before their last round as well. So there was a 20% stock price drop. MongoDB, one of the most high quality software companies in the world, also had a shaky earnings call. Their stock was down about 20%. And they were not alone. 70% of the tech companies who reported recently guided Q2 below consensus, which is worse than when COVID hit. A lot of the blame is being placed on macro. So Benioff came out and said, and I quote, "We're navigating a very challenging macroeconomic environment, which has led to elongated sales cycles and increased deal scrutiny." His president, Bill Milham, said, "We continue to see measured buying behavior similar to what we experienced over the past 2 years, with the exception of Q4, where we saw stronger bookings." This matches what Yamini said a few weeks ago, Yamini, the CEO of HubSpot, where she said, after a strong finish in Q4, we saw a return to weaker demand conditions in the first quarter, similar to what we experienced in 2023. So there's just a lot of questions that have come up in our ecosystem. One is it macro? Is it AI eating their market share? Is this the death of SaaS, or is this a reset? There are a lot of questions that this has brought up. So let's jump into it. Sam, when you made a post last night where you were wondering if this says something about the viability of SaaS as a business model and as an ecosystem, or is it a reset? What are your takeaways from this? How do you feel? What are you thinking?
I'm concerned. I think it's the beginning. I do think I was just at a summit in Santa Cruz with Jaco from Winning by Design and about 50 other CROs and go-to-market leaders at companies from $1 million in ARR all the way up to a couple hundred. Actually, Canva's at $1 billion, and there's a bunch of people from Canva there. So all different ranges. And Jaco's perspective is it's not the death, it's a reset. My perspective is a little more concerned. The issue with so many operating paradigms and operating models, as I've said repeatedly, is that markets are dynamic. So you can fix your business perfectly for the environment that was yesterday, and it might still not work and might be out of product market fit because it hasn't matched the environment of today. Now, I don't think enterprises change that rapidly, but I do worry that it's a reset that could turn into a secular decline, because as CTOs and technology buyers and large enterprises are more scrutinous of their software investments, and as Salesforce and other large platforms reach the edges of their ability to just push expansion, like almost as an inevitability into their customer base on a year-over-year basis, it's not just that those customers are having price sensitivity or buying saturation, but they're also at that point that they might come back. And I think we saw today that Canada is going to be the first central bank to lower its interest rates and hopefully harbor in, another beautiful time of cheaper money, at least on a relative basis. But it might also be true that 12 to 18 to 24 months of time that the market will need to reset in SaaS is exactly the time that non-seat based usage paradigms from AI-powered models and chatbots and support systems will eat into what was left. So even though, as of today, can you say that AI is the reason that Salesforce is going to grow single digits in the next 12 months? No, I don't think you can say that. But will you be able to say that in 2 years? You might be able to say that. So I think there's some concern. For me, it still comes back to not necessarily. I'm not saying the death of B2B tech, by the way.
Yeah, that's an important call out.
I'm saying seat-based subscription models are going to come under scrutiny, and they probably should. What do you think, AJ?
Well, I think the last thing you said about single-digit growth is the important one, and it's what Lemkin called out, which is it was more of a market of, since 2008, Salesforce has had double-digit growth every single year. And so if you're a organization, you look at last year and you see the Zoom Info single-digit growth, that was a little bit of a harbinger, I think, in that same way. But Salesforce that is the B2B beacon that we all look at, that we all think about, that we're all like, oh, okay, what are they doing? What does the rest of the market look like and do? These CEO comments from Benioff and Yamini and others, they're really already saying what we know and what we feel as an operators in the business and what we're experiencing firsthand. But I feel like we've experienced it throughout the last year. We could have taken the exact quotes that they said in terms of demand. We could have said last year. All of they're taking is from what was a positive Q4 and seeing it into Q1 and just setting the expectations, and kind of everyone's jumping on that bandwagon. So if you have bad news to deliver as a CEO, now's the time to deliver it. So I don't think they're going to be the last in the next 6 months to do it, because you're going to start to see it now. Again, with everything, we're seeing this in B2B tech. There are plenty of spaces that are going well. We see the B2BC space, I think, is one of those spaces that we saw or we're seeing. We can talk about cybersecurity. I think you're talking about vertical SaaS is still going pretty well, but those are still fairly new that have popped up over the last several years, and I think those are all going to get tapped out on the TAM. Where this really hits, and of course you're going to mention, Asid, is in the public market. You have two companies in tech that have gone private in the last year. Two, right? And that
what are those companies?
Klaviyo and what was the other one?
Klaviyo hasn't gone private.
No,
you mean public. Yeah, it was Klaviyo.
Oh, that's what I was confused about.
Yeah.
Did I say private?
Yeah,
I meant public. So 2 companies that have gone public and IPO'd in the last year. Klaviyo,
I think the most meaningful were Reddit and Klaviyo, and then there was some other smaller IPOs that happened around it. Instacart happened as well, and they haven't performed. None of these IPOs have performed well.
No, but we have what you would call that train issue, where we're in the caboose and we keep getting whiplash. But last year we were pulled forward, and now we see in front of us that the engine is slowed down, and that starts to hit the debt markets start to change. And that all goes back to interest rates, Asid. All goes back to interest rates. So the news today in the Canadian bank, I mean, I think you and your brother probably have a better point of view on what that means for us around the globe or us in the US. I'm curious, Asid, is that do you see that interest rate getting lowered being a chain reaction to, we talked about in the US that's going to happen in the fall. Does that get moved up now because of that?
Well, it seems like if we click into what was going on in Q4, that hasn't played out the way that the market and these CEOs and the exec teams thought it would play out, is the fact that 2 things converged at the end of 2023. There were strong earnings, and usually there's Q4 has certain dynamics that lend well to earnings anyway. And then you had the Fed come out and essentially indicate 3 to 4 rate cuts in the US through 2024. We're now 6 months in and we've had 0 rate cuts. And rate cuts are important because when interest rates are high, money is more expensive and everybody is conservative in terms of how they spend money. When interest rates are down or are even just going down. Money is getting cheaper, and psychologically, everybody is in a more aggressive mind frame. And so a lot of the expectations that were set in the markets were based on these two factors. This led to a run up in these stocks. These stocks were up quite a lot, right? But there was a mismatch between the reality of the market and what these stocks were reflecting. So they needed to come out with perfect earnings reports not to get punished, and they came out with the exact opposite of perfect. But it made sense. Like when you point to macro, because the big debate right now is it AI? Because if it was AI, there's no world in which Mark Benioff, Yamini, or any one of these people are coming out and saying, because of AI, we are now in single digit growth. They'll get killed. Like that's the end of the business at that point, right? So no one's going to say it. So the skeptics are saying they're not going to say it. Maybe it's that. The reality is that you could say that people are being cautious about spending money, waiting to see if an AI native solution pops up that's cheaper and equally effective. You could say that they're probably reallocating budget from what they were going to spend on these tools to experimental AI budget and testing things in various areas. I don't think that they are spending on AI in a way that replaces the use case that these tools provide today, because we haven't seen such viable applications from an AI perspective out there. To your point regarding the interest rates, I think them coming down has a psychological impact immediately almost. But the practical impact, as Sam said, takes a while. It takes a while for rising interest rates to start affecting the economy. It takes a while for declining interest rates to affect the economy. But there will be some pressure released mentally, and people will become a little bit more bullish because of that.
Well, that's the point that I disagreed with Lemkin was around AI and Salesforce. And the reason for that is quite so. I think he made the point around if anyone can do it, it should be Salesforce. That's like should be able to take that to market. Well, I've used their AI tool, and every single person on our team said Slack AI is useless. It's garbage. Yeah. And so the company execution around products, and if you're a product company, and do either of you think of Salesforce as a product company? No.
They're a sales and marketing company.
Yeah, they're a distribution powerhouse.
They're a distribution company. They're like Microsoft. Except, there we go. I know. Microsoft is both a distribution and a product company.
Yeah, they're very much a product company. Do you know who the world's first PLG company was? Microsoft. Like, think about the Microsoft Office suite that you would buy as a consumer, and then you would upgrade to like a commercial license for your business. It was the first PLG company.
Well, that's just free, and that's the free trial. But my point being is that I don't think you're wrong. But my question back to both of you is: if you're a CEO, if you're Benioff, if you're Yamini, did they miss the mark on what they should have said? Like, what should they have said that should have been different to the public?
Well, I don't think it's about what they said. I mean, I don't know. That's my friend used to be the head of investor relations for a large media company, and a very famous one. And the founder, the owner, and the family matriarch would always yell at him that if you only told the story better, the stock would perform better. And I thought that was a very misinformed view of how markets work, because I don't think markets are waiting with bated breath on every comment that a CEO makes, unless it's a bank, of course. But otherwise, they're looking at fundamentals. So I don't think it's what Benioff or Yamini said. I think I guess where I'm coming out of it is like, I think in the near term, it is a reset. To your point, Asad, it's resetting back to a stock market and a series of stocks that maybe had heated up a little bit and are just poised for more rational valuations. But again, I think the big thing is, to your point, is like, are we done with the age of 120% net revenue retention for true workflow SaaS companies? Because that's
big.
That's scary.
Yeah.
That if we are done with it, then the valuation parts of it, anyone that's raised in the last 3 years is going to have a lot of major issues.
These guys, they're not really talking about their NRR, like they don't report it. But even HubSpot has gone from 110 to 100. at 7% growth, what is your churn as Salesforce, right? Like that, it's interesting. I think the NRR point is really interesting. To the point of could they have said anything different? They had to say what they said because it's the reasonable thing to say. In a way, what they're saying is, hey, stock market, you guys took our prices where it didn't make sense. And you guys, because the market buys the stock to drive up the stock, right? So the market had put them in a position that wasn't unreasonable. And the actual macro setup was different. It didn't play out how everybody thought it would play out in 2020, at the end of 2023. So they came out and said, we're still feeling what we were feeling through most of 2023. And this is how it's reflected in our results. And the market said, okay, fine, we were wrong. Let's bring it down to a reasonable level. What downstream effect, like what is the biggest implication of this for an early or growth stage business? To me, it seems like the IPO window is just not going to open now this year. I think it's pretty undeniable that remains properly shut, which then means that the liquidity these IPOs provide investors that have downstream effects on the ease with which an early or growth stage company can raise funding, that's the effect, right? It's not going to be at all easier to raise money later this year compared to what it felt like last year or this year. Would you agree, AJ?
Just play the tape from episode 2 of Topline. We're saying the same thing that we said a year ago, and we had the very similar conversations around it. What is different here is data. I feel like we have more data and we're more informed and understand what that next year is going to look like because of it. And so there's a level of predictability. And I don't know about you two, but if there's an expectation, I know what this is going to look like. I'm not going to have a fear of it. If I don't have a fear, I'm not going to be afraid of it. And if I'm not afraid of it, then I don't, like, emotionally, it doesn't drain me. It doesn't feel like I'm going to be drained having the same conversation. Don't disagree with you.
AJ, what do you think? Do you think it's a reset? Are you worried at all about the future of SaaS? Is it sort of foolish to talk about it? Do you not care?
Yeah.
Does it have any impact at all on, because I don't want to speak for you, but let's say other companies, other SaaS businesses in different spaces, but similar to QuotaPath. And how I define QuotaPath, raised a lot of money, maybe a year ago, quote unquote, overvalued, but executing now, right? And so on a path to not being a jerk, just saying probably still overvalued, but on a path to where it's that you're closing the gap between what your valuation was and your revenue base. And at some point, you're like, yeah, it'll take me a little bit longer than I thought or wanted to get back to, what you would consider the high water mark. But then from there, I'm in the black because I'll keep going. If I can preserve my capital, I can keep rising past that point of valuation. And, and even up to the point of valuation, there still might be a buyer. There still might be ADP or HubSpot or some big company. It's like, you know what? We know that the last round was at like 200 or whatever. We'll pay 300 because we want the asset. So my point is, like, that was still for you, right? Now there's other companies that weren't executing, that were not growing the right way, or were shrinking, or just didn't raise quite enough money, burned all of it last year. So those companies, they were screwed. But then there's a different class of companies like, yeah, we're overvalued today, but we're going to do this for a long time, and we've got the right fundamentals in place, and we're driving efficient growth. But does this but it's still predicated on, at some point, well, I don't know if it's predicated on that, but I guess that my sense would be at some point it's still predicated on like lowest 6 times ARR and, really sort of expecting 8 to 10 times ARR to come back. And maybe because we're founders and you're optimistic, maybe like, yeah, I still expect that for QuotaPath. Do you? Or is it like, maybe what if we live in a world of 3 times ARR? Now you've just extended, now you're half as far as you thought you were, or I am half. I don't need to blame it on you, but you're a true software company. You're doing well from an execution perspective. You're growing. You got a good team. I know that you felt good about your progress. We all do. Does this change anything about how you see the next couple of years, or you're like, whatever, can't control it?
Our first job as CEOs of venture-backed companies is to return shareholder value. So 100%. We have to be thinking about that. That has to be our first job, and if we're not going to do what we were enshrined to do with this capital, then we should probably fire ourselves. So yes, 100%. Now the timeline is what changes here, and we can't control the timeline, Sam, but we can become a profitable and efficient business. We can get our own unit economics. We can control those things. We can execute off of those things. And we can make good progress. Now, what has changed for me is outside of those things, selfishly, is I've really enjoyed the journey this past year. This is what I've enjoyed. I've enjoyed this conversation. Every week we come into it. And I told Austin last night, I'm like, I learned more about the public markets today than I ever have because of these conversations. And that's what will make me a better operator and founder because of this. And that's where taking a step back and having a great team and all of those things are paramount to being able to do this. So one part of it is, yes, quota path. That's what's going to keep me up at night in terms of how do I do that? Because I'm now working on a longer horizon than I thought. Everything you said is true and not offensive, but that's true for if there's any listener out there that's like thinks differently, then I don't know, who are you, Austin, in this world? If you're like, no, I'm still living in like the 2021 era of what it is. You're working in an AI company. You're working for NVIDIA. You're working for OpenAI. You're doing something that is a very much the actual definition of a unicorn today, not billion-dollar valuation, but a company that is just like printing money. Yeah.
Can I distill that to like 3 points? So you're saying like, yeah, it impacts the time horizon, but it doesn't impact your enjoyment of the job. So all you can do is keep going. Doesn't mean all of a sudden you're building a lifestyle business. It means you don't really have control over the time horizon.
Yep.
And meanwhile, you get to show up and do Topline every week, and that makes your job fun. And if it wasn't for the podcast, you'd be really
if it wasn't for Pavilion, where would I be today?
It wasn't for me and Asid. But is that basically right? Like, I can't really control it, but I like my job. We're building a good business. At some point, the markets will recognize that.
Exactly. And I'm going to continue to inspire my team and drive and dig in with them on a day-to-day basis on what they're operating on, and work on this launch that we have later this month, and work on that deal that we're going to close, and go to that customer problem and just really just face it head on because they're frustrated at something. Like that's what I'm going to do. And that's what I think you guys are going to say you're doing as well, right?
I have some data that backs this up. So I've been trying to look for optimism in all of this. And I remembered something that we discussed on the podcast a couple of months ago, which was we'd had the Pulse report come out for March. And at the time, the data point in there was that 29% of executives in December expected to raise funding in 2024. By March, that number had dropped down to 4.7%. They had adjusted to the reality of the market much faster than the public markets had adjusted. And that was really interesting. Anecdotally, through the many conversations I've had with CROs, I've found that they also are like, we're not waiting for the market to get better. This is the steady state. And we're focused on doing well through good execution within this steady state. We're not waiting for interest rates and all of that stuff. We're not even looking at it that much. So I feel like there's a pragmatism, a resiliency, a thicker skin that has developed on the early and growth stage side, which is that, yes, there are going to be these icebergs that we're going to have to navigate. But if we navigated what happened over the last 2 years, we're pretty sure we can navigate that. Because Sam, to your question, if you distill your question down, your question is, AJ, if your pricing model has to change, are you really scared or not? Right? Like, because the death of SaaS is just the death of a pricing model. That it's not the death of B2B tech. So for AJ, that just means he has to charge me in a different way. And I think AJ...
Awesome. Hey, we take a... Did you just come up with that yourself?
No.
You should repeat that.
What did I say?
Yeah, I love that. The death of SaaS is really just the death of a pricing model, a business model, not the death of software.
The problem is that it's just the best business model that's ever been invented. And that feels somewhat material.
David Scott, you did it. You did it.
Do you
Go
think,
ahead.
Sam, that it's the best business model because it's the business model that used to get the highest of valuations in the market, right? Because of certain dynamics. But we've seen other business models be similarly valued by investors and buyers, usage being one of them. Those companies are predictable, they are scalable, they are repeatable. Snowflake's an example, but there are a million other usage-based companies that get the same type of, that have the same shine that a SaaS company could have. So is it that scary moving to usage from this?
I think, first of all, I can just repeat what some things that Jaco says, because I was with him in Santa Cruz, and we were at the Revenue Architecture Summit, and it was just fantastic. And revenue architecture is included in your Pavilion Executive membership, dear listener. So if you really want to know the basics of GTM, you should probably give me some money. Just some money. But I think you should give it to me.
Sam is in full CRO summit mode right now.
Well, send me a
Give me some,
if you purchase
money. If you purchase today, I'm
you
going to
can go
come
on
to your
stage
house
tomorrow
I'm
at
actually
9 a.m.
in
with
an
Sam
outfit.
Jacobs.
What, you tell me what outfit you want me to show up at your house.
You can go on stage
Anyway,
tomorrow.
Here's what I meant by the best business model. First of all, yes, usage is good, but SaaS is more predictable. And predictability is really important. And it's not just important because it's important. It's important because it allows operators to deploy capital and have a confident expectation of what will happen with that capital. And it becomes really hard for people that have capital, like investors, to deploy capital if they have no idea what's going to happen. And that predictability alone is what gives investors confidence in investing. So just one, that's thing number one. That's not even the most important thing. The most important thing is that you're completely aligned with your customer, and that it's good for the buyer and it's good for the seller. And it's good for the seller because they have predictability, and it's good for the buyer because they have an organization that's committed to delivering ongoing value to them so that they can benefit from it. It's also good relative to on-prem, like the origins of SaaS it's much, much cheaper than having an on-prem data center and having to have SAP or some massive company come in and install software and then update it or maintain it once a year. And so the cost of ownership is much, much lower. So I think that doesn't mean usage-based pricing isn't valuable. It's probably even more aligned to the customer than the seller. But I think that the alignment is part of what made SaaS so important. I think one of the other things that Jaco pointed out in the summit, he said, so first of all, one of the perils of SaaS is that it shifts the risk from the buyer to the seller. In the world of on-prem data centers and on-prem software, the buyer had all the risk because they would make these multi-million-dollar decisions. They'd have to implement the software, and if it didn't work, they were screwed. And in the world of SaaS, the product companies like QuotaPath invest in new products before they know if anybody's going to buy them, and then people only rent them. They don't actually ever buy them. And so the ability to recoup your investment extends over much longer periods of time, and the risk really is transferred from the buyer to the seller. I thought that was a really interesting point. The other point that Jaco makes is that the reason that 20% discounting doesn't work in SaaS is because SaaS is the discount already relative to having on-prem software. That is the discount. And so all of the even further discounting just erodes the core unit economics that enables SaaS to exist in the first place. That's an answer that requires a little bit more math. So
because that could be debated, right? Like we sometimes become very dogmatic because we tie our egos to discounting. It's just a mechanism. There's many places in which it works really well, and there are many people that have used it very effectively in SaaS with perfect unit economics coming out of the machine, but they've used discounting really sharply. So I think that point's a little bit, it's debatable.
Yeah, maybe that's a little fuzzier.
Yeah,
I just think that it's a beautiful business model primarily because maybe usage better aligns the incentives of the buyer, but the seller and the buyer are very much aligned in SaaS in a really nice way that the product roadmap has to map to customer preferences because otherwise the customer will not renew. And that act of renewal is this really powerful thing that really pushes the buyer and the seller together in a very beautiful way, besides the fact that it's deeply predictable. But to take the other side of the equation, seat-based pricing, the pricing framework is it's not arbitrary, but we shouldn't solve backwards from what the ideal pricing framework is. We should solve backwards from what's the best way to deliver utility at good margin that meets the needs of both the buyer and the seller.
I think when we compare it to on-prem and we look at stakeholders and the effect or impact on that stakeholder, it is true that SaaS is better than on-prem from almost every direction. Because sure, it shifts the risk onto the seller, but at the same time, it makes business building more viable because investors were way less excited to invest in technology companies when it was on-prem. And every startup had to sell six-figure deals and figure out how to do it. And the TAM for the ecosystem was very restricted because of that. Because for me, how many six-figure purchases am I making, right? But I'm making many $10,000, $20,000 purchases. And so I think nothing increased the TAM of technology more than the move to cloud, which enabled SaaS. But if we look out into the future, we're not going to go back to on-prem. We're going to move to usage. Usage is better for the customer, right? It is more aligned to the customer needs. It's a little less predictable, but it's not predictable. And the rest of the mechanics of a software company that make it one that you're willing to give a high valuation to, one being high gross margin, those stay. So I think actually, as we're talking through this, is it the death of SaaS? Probably, right? Probably the death of seat-based pricing. Maybe not today, but it's a slow death that will play out over the next couple of years. We know so many progressive CROs that are already moving from seat-based to usage-based. They're at the tip of the spear. They're ahead of the curve. They're figuring it out. They want the competitive advantage that comes from it. They're willing to take risks to do it. Do we see in a couple of years from now the majority of the ecosystem has to do usage-based pricing? Maybe just because there are not that many seats in these organizations anymore. But that's not the death of our ecosystem. Our ecosystem, I think, gets bigger and more robust. It doesn't contract because of this.
The rental versus buying analogy is really good, by the way. That's a fantastic one. But you know who wins in this situation? Who always wins?
The customer?
The government. They always take their taxes. They're going to get their taxes whether you're renting or buying somehow.
The Jews win. I'm Jewish. It's a joke.
You're allowed to do this. Am I allowed to laugh? I don't know.
I think so.
I think so too.
And with that, a word from our sponsor.
Today's business landscape is full of uncertainty, and succeeding as a go-to-market leader has never been more challenging. Pavilion is here to provide you with the education, support, and resources you need to grow, learn, and unlock your full potential. Join more than 10,000 of the world's leading go-to-market executives in a private membership community designed specifically to fuel your success. Visit joinpavilion.com and use the code Topline20 to get 20% off your membership. That's joinpavilion.com, and the code is Topline20 to get 20% off your Pavilion membership. And now, back to the show.
Okay, let's click into the other side of the ecosystems, because a lot of the discussion that we had last year and that we heard last year was around how if IPOs are not happening and fundraising is difficult and doing business is hard, some companies will need soft landings, and M&A is going to be that soft landing. Two things came out last week that I think are super interesting. The first is Vista just wrote off $3.5 billion, basically writing off the entire purchase of Pluralsight, right? Yeah. And that's significant. That is a big chunk of a fund. That's a huge purchase. PE doesn't get to write off things the way that sometimes the VC does, because they're so much more concentrated in their bets. And that's quite significant. And the reason for it was because the debt burden, they were unable to service the debt. They got that debt in a low interest rate market, and interest rates are different. And they were having a really tough time servicing it. And then the other data point came from Carta, which basically looked at the percent of companies across various stages that have been acquired in the last 12 months or in 2023. And from pre-seed all the way to Series D, the highest percent of companies that got acquired was 3.1% of Series B companies. There was no stage at which even 5% of these companies were getting the soft landing. So is there no soft landing, and hence you're just going to have to power through this? Like, what does this mean, AJ? Like, to you as a founder, you talk to all these other founders that are wrestling with the market. Some are looking for soft landings. It seems like those soft landings are not available.
Well, let's talk about Pluralsight for a second. So for everyone out there that doesn't know what Pluralsight does, they do online courses. They're online courses, they're a content machine. They acquired a company called a Cloud Guru a couple of years ago that I knew lots of people that worked there. A Cloud Guru was for online courses for the cloud, for developers, and Pluralsight does that at the IT level. If you just heard a ding on this, it was actually because I went to their site and the intercom like dings really loudly. And I looked at Hacker News because I was really curious as to what was happening in the forums. And the really big theme in that was around the content, and what they have offered has become stale in the last several years. And PE, if you think about what private equity does, it's not innovating. It's taking the shell, it's taking the husk of the thing and just doing it. And if you need something to completely continue to innovate, I mean, Sam knows this better than anyone in the community in terms of what he is providing for coursework. You have to stay at the edge. And a PE-backed business, by nature, is not going to be doing anything innovative. So it is not super shocking that Pluralsight itself is, being written down and written off by Vista. And by all accounts, Vista is a PE that has figured it out in lots of different ways. You had Marketo turn around in 12 months for 4x. They've bought Salesloft. They've bought lots of different organizations out there, and they're making good money off of it. To see them come out and write it down is it's a harbinger of the debt pieces of it that is weighing down some of these companies and are going to have to restructure.
Do you see more of those happening because of the fact that a lot of those purchases happened in 2021 with low interest rate debt that now has to be set up again at a higher interest rate? And the fact that because PE doesn't invest in product, and now is a market in which if your product is not up to par, people will churn. So there's going to be business pressure and then this financial pressure on these organizations. Do you foresee more of these types of shutdowns happening?
I'm not an expert in PE, so I can't speak to the PE part of it. Well, here's where my prediction. I have gotten pretty good at venture. After 10 rounds of fundraising in 10 years, here's what I said last year, and here's what absolutely holds true. I still very much believe that the growth equity funds that still have lots of capital in their funds need to deploy it, are going to work on the companies that are executing really well, deploy capital, and therefore those soft landings are going to happen. We will start to see the M&A pick up for a very early stage at the end of this year. Now, it's not going to be the wins that all of these operators and founders want, but they can start to have a bet and a smaller piece of a much bigger pie of a company that's executing and finding home for their people. That's what I think will ultimately happen. But if you are this bigger organization that is strapped with debt, I think it's going to be really challenging to find a win when you're just holding on in the next 2 years to try to figure out a way where the interest rates come down and you can restructure that. But you're saddled with it and you're ultimately going to hit a breaking point. So we're racing against the clock, I think, for some of these bigger organizations. Asad, again, I'm not a CFO, so
yeah, that's
I don't
interesting.
know.
Sam, what are your thoughts on all of this? Were you surprised by the M&A numbers? I was surprised. I thought it would have been higher.
I don't know. I find my initial reaction is I wonder if we got to look at the data and the data set and figure out what's actually being cross-referenced. And also I need to compare it year over year and compare it year over 2 years. I still think the sense that I get from the emails that I get, and I get emails from investment bankers, and I get emails from private equity firms, and I get emails from, those are the two people I get emails from. Basically people saying there's a market for what you're doing, there's capital to deploy. I get the sense that there's soft landing money.
Oh yeah.
And what do I mean by soft landing money? I mean that lots and lots of PE firms are looking for the platform that they can anchor a bunch of roll-ups around, and they're looking for the roll-ups themselves, the add-ons as they would say. And I know even when I'm texting with a friend of mine that just started a private equity fund, and he's like, we're doing lots and lots of closings, and he's bought like 3 or 4 add-ons, which would be the equivalent of the soft landing concept. Now, they're not always. Sometimes in lower middle market private equity, an add-on is I bought a big HVAC maintenance company and I bought a smaller one in Omaha because I bought the first one in Lincoln and whatever. So it's not necessarily B2B tech, but I tend to agree with AJ that I still think there's lots of capital out there. Now, in Carta's data, what's included in that? Maybe lots and lots of 1 and 2 person companies or 5-person companies. I don't know if Carta has a PLG motion, but lots of people use Carta that don't have any meaningful momentum at all, and they're included in that data. When I see, it's the same way that we can say that 3% of people have this IQ, or 3% of people, or 5% or 10% of people earn this much money. And when the 3 of us hear those statistics, we say, yeah, sure, but we are already the exception to a lot of those ideas, and we will continue to be. So what I see is private equity, growth equity, investors that would want to invest in Pavilion or make Pavilion part of a broader roll-up strategy, or investment bankers that are representing the buyer or the sell side in those transactions. I'm getting as many, if not more, emails from those people as usual. And I'm getting emails specifically from private equity firms that had checked in with me 6 to 9 to 12 months ago, wanting to get a pulse check on the business because maybe there's an opportunity to do something. So I'm still bullish about, M&A. Not at valuations or multiples that people are super excited about, but still an option, soft landing, right? There's an option to find some home for the asset that isn't zero.
I had a conversation with a really senior partner at a tier 1 PE firm yesterday. And he basically said what you were saying right now, Sam. He's like, the most interesting thing they've noticed is founder expectations around multiples have right-sized. He's like, we have no complaints anymore. We are able to structure good deals with them. He's like, till last year, there was a mismatch. They still wanted multiples that we couldn't offer. Right now, everybody is kind of on the same page. Can
I say something to that, Asad? It's just fascinating. I'd love both of your take on it, because it's just really, Kyle calls it a hedonic adaptation, but there was times in 2021 when people that all of us know, me and AJ were in the Hamptons on our CEO Pavilion trip, and one of the CEOs that has since sold his company said, I'm going to be the first billionaire of this type.
Really?
And,
wow.
Yeah, and the implication, everybody was like, well, I can't. How on earth could I live on less than $100 million? What am I, a pauper? And I, if you're out there listening, you might, get nauseous if you hear that or think, what a bunch of jerks. But my point isn't that. My point is that, to the point of founder expectations resetting, and then there's a moment when you change the inputs in your spreadsheet. And the first time you do it, because I don't know about you guys, I have a spreadsheet. I have a spreadsheet that calculates different outcomes for different private securities, of which, of course, Pavilion is one, and spreadsheet for if I sell my house for this versus that. And there's a moment, you lock in on those numbers, and then one day you change the numbers and they're much lower. And then there's a party that's like, I don't know, so what? What's the difference between there's a difference between, as they said in Succession, right? $5 million, $3 million, you can be un poco loco, as they say, but still, if you keep your desires and your appetites modest, that can be just enough. Yeah, there's a difference between 5 million and 100 million, but there's not really a difference between 5 million and 7 million or 5 million and 3 million. And I'm not being insensitive, I hope. I'm not immune to the plights of, the working class. I'm just saying that there's a moment at which you realize, like, changing the number in the spreadsheet, unless I was planning on buying like a mansion and I'm living in a studio apartment, then maybe it like really impacts your quality of living. But if you're basically going to live whatever life you're living anyway, and it was just whatever number was going to inflate your ego the most, then it's not that hard to say, you know what, a couple $1,000,000 is still pretty good.
Yeah.
So Sam is cousin Greg, is what he just said right now. Cousin Greg from Succession.
AJ, you speak to this a little bit, right? Because at the time when you raised, you must have been thinking billions as well.
I don't have a spreadsheet. I actually don't. I have advisor, and I think I do agree with Sam. You're going to live your life how you're going to live it. I kind of tend to think that it's like, I know what this could look like, or I know what I could be doing if I wasn't doing at Quota Path, but I just haven't had a spreadsheet for a few years. I had one at Trendkite, and ultimately realized that, like,
when you had an outcome and you're like, I'm good now. Now I'm going to focus on other things.
I think it was the opposite. I think I got jaded from it, Asid, a little bit. A lot of people think founders, they just like, you see a $225 million exit and everyone's like, oh, AJ, you have $225 million now. What are you going to do with all that money? But the reality of the situation when there's a lot of, like, when you raise a Series D and you're a founder, you don't own 50% of the company. You don't own 25% of the company. You'll be lucky to own 10% of that company. Mm-hmm. That's the reality of the situation. And so that outcome, Sam's right, that $1 billion outcome is only going to be reserved for like a very, very small few. This is my second company. It won't be my last company because I am enjoying it. And that's a part of it. But at the same time, like right now, if I have to walk away from it because something happens, my health or family, God forbid, it is what it is. And I'll start over and do it all over.
You have a spreadsheet, Asid?
I have a spreadsheet that I made for the first time like a few months ago, but it's not an enterprise. It has nothing about enterprise value in it. Because I don't ever want to think about selling this thing. I think there's no
Maybe I just need to delete my spreadsheet.
I mean, let's talk about that for a second. At the beginning of the year, you were talking about the 500 KPI, the spreadsheet with the 500 KPIs, or every morning.
That's for the company. I meant my personal spreadsheet.
Right. But do you still have that 500 KPIs that you look at?
We've distilled it. I mean, that's a whole separate topic. That's a topic about inputs versus outputs, lagging indicators versus leading indicators. I've distilled what I care about. I care about NPS, cancellation requests, basically ARR. Those are like the three. And it's
my point being is I found if I get fixated on a number, it drives me like it's the only thing I can ever think about. I go to sleep, I get just crazy and I get stir crazy about it, and ultimately leads to like potentially a worse outcome. That's for me personally. I get obsessed. I'm an all or nothing person. I have a spectrum of like, if I'm going all in, then I'm going to lose 25 pounds in 2 months. And like, that's because
being super unhealthy.
I just made that up off the top of my head.
Sam, have you seen him today? How thin does he look?
He looks great, actually. He's got some nice socks on.
Okay, there you go.
Oh, yeah. I like that. I am wearing these are one of my customer socks, by the way. It's Optibus. It's one of my.
I love their work. They do the bus, but they also do the Opta. So then it's Optibus together. Perfect.
They must have raised money in Zerp as well if they're making socks for people.
They're an inside back company, so I guess so.
I think spreadsheets can be either really helpful or really hurtful. I think they rarely fall in the middle. I think for me, I've chosen not to put enterprise value in it because I'm not at all thinking or want to think about what happens if this sells. I just want to keep building. But it is very common for me to sometimes take a look at, okay, does this all make sense? Am I going to be appropriately comfortable? Can I take care of my family, my extended family? So those things are calming to me. And so I made one. I was like, okay, this is fine. Like, let's focus on work right now. But I very thoughtfully didn't put enterprise value in it, because I think if I was looking at enterprise value in there, it would put me in a short-term mind frame of like, okay, what do I need to do to drive this up in the near term, and hold me back from thinking about things from a much longer perspective. I think we need to build businesses thinking in decades, not in 1, 2, 3 years.
Yeah. One last thought on the Carta point, by the way, is that you were talking about what data Carta has. Sam said that. I actually talked to Peter yesterday from Carta. What is it missing? It's missing valuations at these bigger companies. So they actually they can't actually see past that chart that you shared with us, Asad. They don't have the valuations of a Pluralsight. They don't have the valuations of some of these private companies that are bigger, that are acquiring these smaller companies. So they don't actually see the endpoint for some of these outcomes.
They should just get a PitchBook license and go see it then.
I will just say, in closing this out, Asad, to your point, as you both know, and I'm sure people can read between the lines that listen, I've been going through some personal stuff over the course of the last year. And in that world, my spreadsheet has given me a lot of comfort.
Yeah.
And the reason it's given me comfort is because it's saying, in the worst case situation, you're still perfectly fine.
Yeah.
And that has helped me not have too much anxiety about like, what if this happens? What if that happens? I agree so for me, I felt really calm. But the numbers on the spreadsheet are lower numbers than they were a couple of years ago. And that's my point. And I'm still like, yeah, it's fine.
It's fine.
It's fine. What's the difference? The difference is, I'm here in Boston. I got to go to Santa Cruz. I got to go for a run and listen to the Seals. And, then I get to go to London, and we're going to do an event on July 4th in Paris. Life's pretty good. So as long as I can keep building and fixing, continuing to improve Pavilion, I should be in okay shape.
And that's kind of what the PE person was telling me. He's like, people have just relaxed a bit. They understand what's reasonable. They understand what's rational. We're putting together some good deals. There are many founders who are coming to us and saying, let's do a roll-up, and here's my game plan. There are many founders. And in roll-ups, there are many situations where some founders get to leave and some get to stay and be CEO and help build it out. There's really exciting potentials over there. And so when I was discussing the Pluralsight thing with him, he's like, it doesn't scare me. He's like, this thing it's unique to certain PEs that did certain types of deals. He's like, we've never seen more deals, we've never done more deals, and we're never more excited about the reasonable nature of the deals that we're doing and the potential for us to create real enterprise value through some really smart roll-ups in real America, like real businesses that are selling to real businesses, that type of a thing.
How many founders came up to us when we started this last year, during the SVB crisis, when so many things are unknown, and said to us, like, hey, Topline was my solstice. That was my savior. Listening to you all, of trying to figure out, trying to understand what was going on at that time because of this unpredictability. How many founders came up to us? A lot. Today, I don't think that's the case. And that is great because we are giving this very clear, broken record type messaging in terms of what this is going to look like. We actually have clarity. The Fed has told us we're going to have clarity. We know we have a presidential election. That's going to throw some things into this, of course, at the end of the year. But we know what this is going to look like. And just like your friend and he said, this doesn't scare me either, Asad.
I think it'll be really interesting to track what happens with our respective businesses over the next 5 years.
Oh, yeah.
Because part of my instinct, because there's two ways to read our comments, right? One of the comments is listen to these guys. If I were putting my shoes in the shoes of Jason Stebbings or Harry Lemkin or some some uber Silicon Valley type, right? Listen to these guys running their lifestyle businesses. They're not world changers. They're not Aaron Levy. They're not going to change the world. But on the other hand, I'm listening to us. I'm like, we all sound pretty healthy, actually. We all sound pretty reasonable,
level-headed,
pretty focused. Well, the top two metrics I mentioned were not revenue based. The first, NPS is my North Star, and delivering member value. I'm sure it's true for both of you.
Yep, payouts.
Asad just said he wants to run his business forever. AJ's like, I don't know, I'd start another one. I really like this. I'm having fun. And so if I had to say for the three of us, I would guess that there are going to be outcomes should we wish to pursue them for the three of us, precisely because we have the right mindset. And I think it's, on the one hand, you can say, like, we sound like private equity owners, like we sound like private equity backed CEOs in some way, I guess. Maybe we're a little bit more empathetic, but we don't sound like we're trying to, like, if we don't build the next rocket ship to Jupiter, then we will consider ourselves a failure. And on the other hand, it feels like maybe that's the only way that you can succeed, is if you just buckle up. You're like, I'm going to enjoy it. I'm going to try and live within my means, and I'm going to build something that helps people.
I think that's the interesting thing, where, like, you listen to some podcasts and you think the only path to success is this binary outcome of you try to build something that becomes a $1 billion business and you become uber wealthy along the way. Sure, like, there's that, but there are many other ways to live a really fulfilling life and make a lot of money. Like, listen, we made a lot of money. And we live very happy lives. We do things that we enjoy. And I think this is also a more common journey, is to build businesses of this sort. And so I think it makes it a little bit approachable for people. And it's interesting for people that are running businesses of that sort.
Let me ask you this last question, though. Go ahead, AJ. You've been trying to say this for a second.
I was just going to make my joke about Topline outliving all of our companies.
That's actually funny. I was like, he's been trying to say this for like 3 minutes, so it's not going to be funny. But actually, that's pretty funny. But Asid, and now this is a joke I was going to make before where the timing would have been perfect, but now it's not really quite perfect.
I'll still laugh.
But what percentage of your flights are scheduled?
Flights?
Yeah, when you fly, what percent are scheduled?
Meaning, like...
And you live with that. And see, it's not that funny.
Like, how much is private versus not, basically?
The joke would be that, like, if you're not flying private mostly, how can you even be happy? Yeah. That would be the joke, but I just had to explain it. It's not that
Sam,
funny.
What if you own your own airplane? What about that?
I know, that's what then you would say, none of my flights are scheduled. And then they're like, but they're flying in a Beechcraft, not in a friggin' in a Learjet.
On a Gulfstream.
Okay.
Anyway, all right. Oh. Is that it? Are we done?
Yeah.
Shout outs and wins
We're
of the
at
week.
the hour. Shout outs.
We didn't get to meetings. I did a whole preview on LinkedIn saying we're going to get to meetings
last week. Isn't that what we talked about?
That was loneliness.
Oh, that was loneliness.
Yeah, so it's good. This way we always have things to talk about next time around.
We'll get there.
This was an important discussion, though. I think, like, it was so meaningful what happened. It's crazy not to have broken it down. But shout outs. Who's run first?
Yeah. I'll go first. I never go first, so I'll go first. I want to shout out the team from Winning by Design, and I want to shout out Jaco Vanderkoy. Jaco welcomed me into his home on Sunday. I flew to San Fran, took a Uber to his house, and then we drove to Santa Cruz together. And then we went on a run into the Enchanted Forest, he called it, which I think is Wilder State Park. And it was 1 mile straight up at the beginning, and then all through these trails and down into this old forest and back. It's truly beautiful. But really, the cool thing was the first 2 days of the summit, when we went through revenue architecture and really understanding the mechanics of a SaaS business and of a go-to-market engine. And I learned a lot. And one of the best pieces of learning was about, the difference between open loop and closed loop systems, and how small changes, once you're past 10 million, small changes that you can say your win rate is 30%, your win rate's 25%, but your win rate is comprised of 4 or 5 different actions that each have their own independent conversion rate. And so the idea is, can you change small conversion rates throughout the system that can create massive improvement? And I love the example that he gave, which was the first 5 minutes of, not 5 minutes even, the first 120 seconds of a discovery call. And whether there's a professional that joins the call, meaning somebody that says, hey, Asid, how are you today? It's great to see you. Or somebody that has, a laundry hamper. And this is not classist. I'm just saying somebody that's disorganized, that doesn't have a good Zoom background, and that comes in with less training, less poise, less presence. And what do we agree that those two people have different win rates? And if so, and is the win rate possibly influenced by that first 3 minutes of the call? And if so, can you make a massive change in your go-to-market machine simply by focusing on how people show up for the first 3 minutes of the call? And that can flow through your entire go-to-market machine, flow through your win rate, not just like train better, but focusing on small incremental improvements throughout the entire life cycle that can actually dramatically transform the performance of the engine. Thought that was a really cool idea. So shout out to Jaco and the team at Winning by Design.
That was great. AJ.
I'll be quick. I'm going to give a shout out to Cliff Simon, Carabiner. Cliff is here. I saw him in the WeWork that we're in right now. After knowing Carabiner and Seamus and Cliff for 4 years, we're going to start working with them this fall.
Oh, wow.
Yeah, our sales ops all-star Brandon Smith is going on paternity leave, and we're going to need some help.
Interesting.
So finally that pays off. Finally, Pavilion has finally paid off for Carabiner.
And it's costing you money.
Well, not paid off for me, paid off for Carabiner Group. I'm kidding. I've heard there's a little bit of an announcement tomorrow at CRO Summit. So excited to hear what that's about from Shane.
Cliff has to be the most active Pavilion member I've ever seen. Every dinner. Like
he's like the most active community member. He does everything in every community.
Yeah, he's hosting a Philadelphia lunch event that Ryan Milligan and I are going to next week. I think it's next week So shout out to Cliff.
Shout out to Cliff.
So I'll end it. It's tradition. Whenever Acquired releases a new episode, I shout it out. The latest one is on Starbucks. They did it differently. It was quite interesting. So they're interviewing Howard Schultz for like 3.5, 4 hours and doing what they would generally do themselves, but with him. And it's fascinating because they spend months researching these organizations, like genuinely months. They read everything. They listen to everything. They will have tons of conversations. But this time they've got the guy that built the company right there. And it's really intriguing to see things they've uncovered that he's like, I don't know how you figured that out. Like, that's ridiculous. They know like there's some nuance from 1985. He's like, how do you know this? And then stories that he's able to bring to the table that add color to their research or were things they'd had no idea about. One little story that I found fascinating was obviously Howard wasn't the person who founded Starbucks, but he worked for them. And then he went off to start his own business doing as a coffee store because the original founders of Starbucks only wanted to sell coffee beans. They didn't want to be a coffee store or a cafe. And so he started his own thing. And then those founders, they got into some financial trouble and they wanted to sell the business to him. He was going around raising money. And right while he was doing that, one of his own investors tried to blindside him by going to the founders and saying, let's cut him out. I'll buy the whole thing. And he was depressed. He thought he was going to lose this deal. And he was playing some sport at the end of the night. And after that, crying to his friend. His friend's like, I work for this law firm. Let me take you to go see one of the partners. The partner was Bill Gates Sr. or Gates Sr. And he basically went and saved Starbucks for Howard Schultz. And he never told a soul about this story. And this was the first time they mentioned the story. And I think there's just so many wonderful stories in business of people saving other people and helping other people that we don't really hear about a lot. But it's such a big part of the ecosystem. And so it reminded me the value of being helpful and always being grateful when people help you. So that was it. That's the shout out.
A great story. That's a
great story.
Oh, yeah.
All right, team. Well, thanks for listening. It was Sunday. If you haven't joined our Slack channel yet, please do so. If you didn't catch AJ's preview of the docket earlier this week, you missed out.
We'll catch it
Anything
next
else
week.
we need to sell people?
Well, you missed being on stage. You didn't join for the CRO Summit. So
you're a loser.
Yeah.
And you missed the WeWork day, and you missed meeting me and AJ in person. And I just met Ryan Milligan in person. So if you're not yet a member of Pavilion, you should join. But thanks for listening, and we'll talk to you on Thursday for Topline Hotline.
Bye, everyone.
Bye.
This episode was brought to you by AirCall, the business communications intelligence platform. Deliver a better experience for your customers and your teams at AirCall. That's AIRCALL.io. Save time, save money, and improve performance with a single communications platform.
Thanks for listening to Topline. New episodes come out every Sunday. If you like what you heard today, subscribe so you never miss an episode, leave a 5-star review, and share it with your friends. Don't forget to join our Topline Slack channel to connect with us and discuss the topics we cover with other listeners. Click the link in the show notes. Lastly, if you're interested in joining Pavilion, you can learn more about membership at joinpavilion.com/membership. Thanks again for listening.